All right, welcome to TheoTrade. Before we get into a discussion of one of the most extreme marketplaces we've seen in many, many years, we recognize, listen, people have got risk on. We want you to learn how to mitigate that risk. Please join us at an open house tomorrow. That is Tuesday, February 6th. We are going to be kicking off the open house. It's going to be 8:20 a.m. to 3 p.m. Central Time. It's throughout the course of the trading day. It's TheoTrade.com/open. Again, to register for this open house, please go to TheoTrade.com/open. It is completely free of charge. We recognize many of you have substantial questions and risk on in the marketplace. Please join us at the open house. Now, let's get to this evening's video. Welcome to TheoTrade. This is Don Kaufman. Here we are. A day that you're going to remember for a long time, February 5th, 2018. Many of the ideas that we talk about here on TheoTrade on a day-to-day basis came to fruition in an extraordinarily short amount of time. You know, there's a phrase that I happened to use on the weekend video. And on the weekend video, I was talking about the volatility. I was talking about the S&Ps having sold off a little bit. And specifically, I said, hey, listen, the volatility hasn't even really caught its stride yet. Well, it did that today. Another phrase that I utilized on the weekend update over here was talking about feeling the fear. If you had no idea what that meant, well, you do now. The S&Ps closed down over 5%. And again, you're looking right now at a 9-month S&P chart, but I got to snap this back for a second to a 30-day 1 hour just to kind of see some of the damage that was done ultimately today. S&Ps falling from almost 2,900, S&P points. People, we closed in on 2,600 even today. Now, I'm not telling you anything you already don't know, but I do want to show you some interesting aspects over here to be very forward looking. Let's not hash and rehash, if you will, where the Dow is almost down 1,200 points. It doesn't do us any good. I want to get, again, as I said, to some of the specifics and some of the real standouts. One of the things in the weekend video I told you to look out for happened to be specific to the XLF. Any way you want to put it. Okay, if the bonds continued to sell off, that was actually going to crush the financials because the interest rates were rising too fast for the financials. But if the bonds rallied, that would really kill the financials. And the financials, and this one's really interesting to me because the financials were at the forefront of the sell side activity. And again, I'm gonna kind of zoom out because literally in those videos, I drew lines and said, you'll know it if the back of the financials is broken. You now know it. The financials are now down year to date. So the financials really get hammered. But the interesting aspect to me, and I'm going to show you this, and I want to spend a couple of moments on it because I think it really, really matters for tomorrow's session. The financials sold off. It was, again, relatively complacent kind of sell-off ultimately until about an hour before the close. Massive sell-side activity. They got a bid back under them. They fell hard again. Here's the point. Okay, that I want to make. Take a look at the percentage drop inside of the financials. They're down about 5% versus the S&Ps. The S&Ps continued to fall in the aftermarket. There is a huge imbalance over here. Now, the S&Ps may bounce after the cash close, but you have to realize that trade is trying to get ahead of the risk out there, meaning that they're selling S&P futures, okay, at anything, at any price to mitigate their downside exposure. And I wanted to show you that because this is where cracks in liquidity are starting to form. What that effectively means, again, the XLF, if you look at this as a sector by sector basis, and we're going to go over here, this is what we call full-blown correlation. It's an all-down day. There's nowhere to hide. But if you take a look at the sectors themselves, let's go over to the sectors right now in the S&P 500, okay, right in here, this is financials. You realize, again, and I'm going to highlight this for just a second, the financials on a percentage basis were down about 5.25%. How did the S&Ps end up then extending those losses? It's because, again, there was sell-side activity into the cash close. So the market's about to reopen. I actually waited to record this video. The market's about to reopen. You're going to see some more chaos hit in just the next few minutes. Huge cracks in liquidity, though, are showing up. And what that effectively means, bid-offer spreads were widening out, okay? It was chaos in the last hour of trade in today's market. Now, let's look a little bit down the list over here. And again, the markets are going to reopen, right at 1430, and the S&P futures will continue to trade. I would anticipate a little bit of a bounce. However, again, when I say there's cracks in liquidity, ultimately, again, the sector that leads us, all right, in terms of the downside is the XLF. And how does the S&P end up below that? That's because traders were actually selling the S&Ps, all right, like it's going out of style. They're now open, and they're continuing, all right, some of that fall. Again, I would expect to see a bit of a bounce back. Nevertheless, it got real out there, people, today. This is going to be splattered, the headlines over everything. Now, let's be forward-looking. By the way, as I'm saying that, they're continuing to sell the S&Ps here in the after hours. The S&P's down now almost a full 6%. So, to continue, opportunities, they're everywhere. But you literally have to stare down the face of a marketplace that just fell by 6% in a day. Now, would I call that an all-out crash? No, but over the last 2 trading days, we've done some very, very serious damage to equity products. Before I get into what I view as opportunities, let me state what are not going to be great opportunities. If you're looking right now and thinking to yourself, oh, wow, I'd really love to buy a tech stock, right? I'd love to buy Apple, at the 150 level. Be extraordinarily careful. You have to recognize, again, and I'm going to bring up Apple and use it as kind of, a little bit of a case study. Then we'll come to a few other underlyings. Apple has already had, all right, its fair share of sell-side activity in the days that preceded today's, huge decline. Apple's only down about 2.5% today. However, I ask you for a moment, if you're going to consider buying, and a lot of people are going to go out there and try to bottom fish, okay? Please do yourself the favor, open up at least a 3-year chart and recognize how far we have come. That Apple's little sell-off over here only took it back to where it was just in early October. That in the broader scheme of things, we're still just scratching the surface of a marketplace that hasn't but had a downtick. Well, now volatility is cracked wide open. This could get serious. And if you go out there and buy a security, okay, in a marketplace that's showing, again, as I said, cracks in liquidity, you are going to sustain at some point some serious amounts of risk. There are times that, of course, we'd love to consider bottom fishing. But again, let's bring a little perspective into this. This is a 3-year daily. A 3-year daily on none other than Facebook. And you realize that you can barely even see the last few days of a down move. Here, Facebook is down, 5%. It hasn't but scratched the surface. Now, again, I know that everybody's like, they want to be a little constrained in a buying opportunity. Okay? We may be entering into a substantially more volatile period of time. A period of time that, again, in a marketplace, let's go over to the spiders for a moment, in a marketplace that has been bid up year after year after year. This is a 5-year weekly. You're just now capable of seeing some of the damage that was done inside of, again, 2 trading sessions. Gain perspective, all right? And the perspective is we are still, if you look at this in a longer term time frame, an incredibly risky marketplace out here, that just for us to get back in the S&Ps, to get back to where we were midsummer, the S&Ps have to fall down to the 250 range. And those are serious numbers. All right. So again, I just wanted to throw that out as a little bit of a shot across the bow, a warning to you. Now let's take a look at the volatility. The VIX made one of its most serious moves in many years. The only larger move in any recent years happened to be August of 2015, where the markets went into a full-blown 7% crash and rally. Yet, what's unique about this? This is the highest closing VIX that we have seen. Again, this was a candle where we spiked to a 53 volatility, but ultimately reverted back down and closed, okay? Where? Below 30. This is the first time that we've really been above the 30 region and closed above the 30 region. So premium sellers, note that. Why? Markets today, most definitively, they felt the fear. And again, there's that phrase again. And if you don't know what it means, all you had to do was watch the screens today or turn them on right now and realize that they're down some 5%. This is now going to be, okay, without unequivocation, an expanded period of volatility in the marketplace moving forward. So once the markets kind of felt the fear over there, they're not going to collapse volatility back down to a VIX of 9 or 10% for quite some time. We are going to have sustainable, elevated periods of volatility. All right, let's move a little bit beyond the VIX into the volatility of the VIX because, well, this one speaks volumes. The VIX of the VIX jumped and closed to 177. Once again, you're looking at levels that have never really been sustained that high. What this basically says is the VIX options themselves, okay, their volatility is trading on a 177%, okay, implied vol. Now think about that for a second. I happen to have a VIX volatility spread on. And if you start looking at some of the options in the VIX, first of all, the bid-offer spreads, they're all over the place. I would have loved to have traded the VIX a little bit today, but you really couldn't. The liquidity started to crack apart such that the bid-offer spreads were so wide you could drive a truck through them. We will look and continue to look for some continuing opportunities inside of the volatility product. However, we need markets, if you will, to be a little bit more constrained in terms of how wild that movement was. Even inside of the spiders today, which I just brought these up a moment ago, but we were looking at the options, okay, that were 2 days out in time. And the options 2 days out in time, the bid-offer spreads went absolutely wild. Here's another fun one. Today, I did an intraday trade on the IWM. Okay, you can see that I've got a position in here. I bought an at-the-money option. I didn't do the trade big. Okay, I fired off one contract. I did not get an opportunity to close it by the end of the day. This is an option, okay, earlier in the day that we ultimately paid just about $1.60 for. In fact, if you're kind of curious, you look back some of the fills. I went out there and tried to buy back some puts, sold a couple puts in GE, right? But if you look back to like some of the first orders I did today, sold a few iron condors in the IWM. There it is. I paid $1.59 for some puts today. I couldn't get out of them. Okay, I tried to like middle of the market, maybe $8. It's an intraday position that I kind of got stuck holding. I am fairly secure in the fact that I'm going to be all right in that particular trade. Not like I have a lot of risk on the table, but there's where one contract, right, can do some serious damage over here. Again, we put on a whopping one contract for about a 400 or 500% return on the trading session. Now, moving forward, as I said a moment ago, I had a tough time. I was trying to position myself in a couple of different ways in the VIX, where I did get a couple of fills, happened to be inside of the spiders. I went out and I actually sold a few out of the money iron condors. And again, I'll be very specific over here. We went way into the future, okay, on these iron condors, down to the 240, 245, 240 strike, and all the way up here to the 290, 295 strike. And I was able to execute those trades for right in the neighborhood of anywhere from $1.23 on up to almost $1.50. It's a $5 wide put spread and a $5 wide call spread. All I wanted to do at that point was see if I was capable of executing in what was one of the highest volatility circumstances that we've seen in many years. Fired off a couple of contracts. I'll continue to work a number of premium selling opportunities. Now, feels a little strange because all of a sudden, we were talking about a marketplace that was incredibly efficient, going to a period in a transition of inefficiency. This is inefficiency. And in an inefficient market, I'm telling you, this thing absolutely reeks of opportunity out there. Join us, okay, in the chat room if you have the time, live throughout the course of the next couple of trading days. This is not going to be boring. We're going to execute some trades. Incredible opportunity has opened up. I hope that many of you tuning in on a day-to-day basis have not only learned how to reduce your risk from TheoTrade, but really how to reduce the risk, control the risk, because right now, again, when markets get wild, therein lies the opportunity. Thanks, everybody, for joining us at TheoTrade. Have a wonderful evening. Bye-bye.